Good afternoon. I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings. I want to welcome you all to this event. I can't remember what we called it. Beyond Bitcoin, the future of blockchain and disruptive financial technologies. And this is, as you know, obviously on the record and is being webcast. So if you don't want anybody to know what you say, don't say anything. So we thought about this event for a very simple reason. To many of us, Bitcoin is somewhere between a fad and a fraud. It has been promoted by some people as a cryptocurrency embraced by modern-day gold bugs and survivalists who are united in their deep distrust of government, and their rhetoric suggested as much. And that's a very good story, I can say as a former journalist, and I think that's why you've read and heard so much about it. But to focus only on that is to focus on the people who said that the internet was a fad and that the only possible commercial use for the internet was pornography. So today we're going to set aside, I think a little bit, although Barry Silbert may disagree with me, the long-term and I think remote possibility that Bitcoin will replace the US dollar someday. And instead we're going to try and focus on the technology that underlies Bitcoin, the distributed ledger, the blockchain. I wrote a little Q&A on this subject, and I loved the statement from the director of research at R3CEV, which is not a character in Star Wars, but it's a New York startup that's basically a consortium of over 40 banks. Tim Swanson, who's the head of research at R3, says blockchain is a bit like gluten. Everybody talks about it, but no one knows what it is. So we're going to try and solve that problem today, or at least make a start. There are people up here who can explain this better than I can, and I'm going to let them do that. But basically, the starting point is to think about a payment system, the way money moves around the economy. It needs trust. People won't accept payments if they can't count on the payments being of value. A loss of trust in a currency or in a bank can lead to a destabilizing run. And the question is, how do you generate that trust in something called a distributed ledger, where banks aren't at the center of it, but that the ledger, the record, is distributed and sort of jointly and severally guaranteed by all the people. Now, when we give money to somebody, we know that I had the dollar, I give the cab driver the dollar, he has the dollar, I no longer have it. It's not so easy to do that electronically and have people really trust that. So part of this is an effort to exploit a technology that allows us so that we both can't claim the same digital dollar, if you will. It's complicated, it's not intuitive, it's unfamiliar to many of us, but I want you to put yourself in the position of where people were in 1993 when the internet was embryonic and Netscape came out with the first browser that really changed the way we use the internet. That was 1994, that wasn't so long ago. And we are now at the stage, I think, where we're in the pre-Netscape stage, or maybe we're right at the Netscape stage. And so things that sound very foreign and complicated and maybe even a little bit scary, you can either say, throw up your hands, or you can try and understand it. And what we're going to try to do today is understand it. Now, there are a lot of people in this room who are putting money into startups that they hope will exploit this technology. They're obviously enthusiastic, or they wouldn't be putting their money there and they wouldn't be here. I was struck by a report by some economist at the Bank of England, which is not generally known for wild-eyed irrational exuberance about Silicon Valley's latest idea. And they described the distributed ledger, the technology that underlies Bitcoin, as, quote, a significant innovation, one that could change the way money moves around the economy with less cost, less fraud, fewer mistakes, and more speed. And they say it has applications outside of finance as well. It's already being used by some universities to store student records in an encrypted form so that an employer can check a CV of an applicant. And the Bank of England recently ran a competition for students to say, come up with ways that blockchain technology might improve the life of people who live in the UK. And the winning team, 4 students from the University of Edinburgh, came up with some scheme, which they have not yet posted online, they're probably waiting for their patent to be filed, that will somehow be used in the National Health Service's blood supply chain to identify, so there's an immutable record of how the blood supply thing is. Now, our goal here at Brookings is to improve governance, and the goal of the Hutchins Center is to improve the quality of fiscal and monetary policy, broadly defined, and public understanding of it. So any new technology, particularly one that is invading something as important and as regulated as the payment system, is going to raise questions of policy. How do we get the benefits, the efficiencies, the new products and services, the financial inclusion, without adding to the risk of financial instability, money laundering, terrorist finance, and hacking? How do we rewrite rules to encourage innovation, to foster startups, new entrants, without unfairly disadvantaging regulated financial institutions upon whom our economy depends? On the other hand, how do we set up a system so these regulated financial institutions, the big banks, the credit card companies, don't use the government, the regulators, the supervisors, to prevent the entry of a new technology that could erode their profits? What is a level playing field when the ground is shifting under our feet? So these are the questions we're about to explore. We had a very lively discussion this morning with some of the people in the industry and in the government and in the nonprofit sector who think about these things. And I think that one of the things I've learned is that this is the kind of thing you don't get when it's explained to you the first time or even the second time. So I look at this as a continuing effort to explain to people who kind of know in the back of their mind this might be more than a fad or a fraud, but explain to me again, what exactly is this and why should I care? And is this the internet 25 years earlier, or is this something that is going to be the subject of parody and ridicule because everybody thought it was going to be great and it vanished? I want to make one more point before I introduce our panel. This event is 100% funded by the Hutchins Center on Fiscal and Monetary Policy at Brookings. There are people we invited who have invested in the industry, and we invited them because they've invested and they know something about it, but they had no control over the agenda. They didn't get to veto anybody. Glenn Hutchins, who contributed the money that led to the creation of the Hutchins Center, has investments in Bitcoin. I don't actually know what they are. He didn't have any veto over this, and this isn't meant to serve his business interests. I'm very grateful to my colleague Seth Wheeler, who left the government recently, the Treasury, the Fed, the White House. I don't know why did you stop there? You thought it could have gone to the Justice Department and the Department of Education. He left the government. He spent some time here at Brookings. He's about to go work in the private sector, but the company he's going to work for is not represented here today, and it's not anything he says, if he opens his mouth, is speaking for himself in his last waning hours as someone who's able to say what he thinks before he goes into private industry and is no longer afraid. You're in that great sweet spot. You're not in the government, and you're not in the private sector, and so on. There are a number of people here from government agencies who we invited because we're trying to be a bridge between the industry and the regulators. Some of them may speak, some of them may only listen. Those who speak are not speaking on behalf of their institutions, but are trying to help us better understand that. Okay, so enough for that. I'm joined up here by 4 people who are just a few of the people we had in the conversation this morning. Some of the people who were with us this morning are in the front here, and I may call on them, and I invited them to participate in the panel. We don't have to wait for the formal Q&A. But we're going to start with these 4 people we have up here. Michael Barr is a professor of law at the University of Michigan Law School. He's a non-resident senior fellow here at Brookings, and he spent some time in the Treasury during the evolution of Dodd-Frank. So he knows a lot about the financial regulatory system, and he's an advisor to one of the companies in this space, Ripple. Margaret Liu is the Senior Vice President and Deputy General Counsel of the Conference of State Bank Supervisors. A reminder that we have an unlimited number of federal financial regulatory agencies in Washington, plus another 50 at the state level. Barry Silbert is an entrepreneur who I first met when I was at the Wall Street Journal, who had some idea that seemed completely crazy to me about having some kind of market where privately held companies could change their shares, but it wouldn't be a public market. It turned out to be a big success. He sold it to NASDAQ, and so now he's an investor in the Bitcoin space. As you'll hear, he's got investments in 60 companies and showing that doesn't have completely good judgment. He's recently bought into the media business. He didn't ask me first, but I told him last night it was a mistake because we know what it's like to own a media thing. A newsletter, a website called
CoinDesk.
Sorry. Got to get my lingo right. And Brad Peterson, who has been involved in companies such as eBay and PayPal, is now, and was at Schwab, the discount brokerage firm, is now the executive vice president and chief information officer at NASDAQ, which I made the mistake this morning of calling a stock exchange, but it's not. It's a technology company. I learned my lesson.
Thank you.
And they are one of the users of this underlying technology, and so I thought it would be useful to hear somebody who's using this technology, but is not out there buying Bitcoins because he thinks the Federal Reserve is going to put us under in the next 15 minutes. So I've asked first Barry to talk a little bit about the technology for people who don't really know what this is or have a limited understanding. Margaret, and then I've asked Michael Barr to talk a little bit about the policy questions it raises. We're going to have a little discussion up here. I'm going to bring in some of the people who joined us this morning, and then we'll be happy to take your questions. So I'm sorry to be so long-winded, but if I really understood this stuff, I'd be able to explain it much more succinctly. So Barry, would you start, please?
Yeah, sure. So I guess one more minute on Digital Currency Group. So DCG, it's our mission to accelerate the development of a better financial system. And what we do is we build and we invest in companies in the Bitcoin and blockchain space. And then we use our insight, our network, and access to capital to grow those businesses. So as David mentioned, we've invested in 60 companies now, located in 20 countries, which gives us pretty unique insight into what's happening in the space. And we did also just get involved in the media business by buying CoinDesk and are putting on a conference in May in New York. You're all welcome to join, Consensus. Out of curiosity, and actually I should mention, this is maybe relevant, we just raised money ourselves from a really unique group of investors, such as MasterCard, CIBC, CME Group, New York Life, Transamerica, Bain, RRE, and some others, who they themselves are quite interested as well in what's happening with this technology and this innovation. So whenever I get to speak, I always like to do an audience poll. So by a show of hands, on the spectrum of Bitcoin skeptic over here to Bitcoin believer, put your hand up if you're a Bitcoin skeptic. Friendly audience. Okay, well, who's a Bitcoin believer?
Wow. We have a cross-section of America here.
So great. Well, so my Bitcoin 101, I don't need to do much. So just for those of you who are not familiar with this terminology, so I use the word Bitcoin as a kind of a general description of a concept similar to Kleenex and Xerox. There are 600 different digital currencies and lots of different protocols out there. And so when I say Bitcoin, I'm talking about all of them. I'm certainly a believer in Bitcoin. And so think about Bitcoin as three things. Bitcoin is a currency, or it's a store of value. Bitcoin is a financial rail on which money can move around the world. And Bitcoin is a ledger on which information can be stored, ownership information as an example. And so why does it matter? Well, it matters because if you think about the opportunities for Bitcoin as a currency, from a global perspective in emerging markets, the ability for people to store their wealth in something other than a currency that is being devalued or debased year after year, that has some level of appeal, kind of like a digital version of gold. Use case number two, a financial rail. Everybody who has sent money to a person, cross-border, certainly cross-currency, can appreciate the friction and the cost associated with that. Bitcoin has the potential to make those type of movements of money frictionless and basically free, and that's quite transformative. And then thirdly, this use case, this ledger system, if you're involved in the financial markets, you know how inefficient it is to move an asset from a seller to a buyer. There are opportunities in both the financial markets as well as outside to use this decentralized ledger to hold ownership information and in effect, essentially disintermediating or eliminating any of the middlemen that are currently being paid to kind of be that trusted authority on ownership. So kind of where we are in the whole evolution of this industry. So Bitcoin is based on a white paper that was released in 2008 by a person or a group named Satoshi Nakamoto. In 2009 was the first version of this code that was released to the public. In 2009, 2010, and for the better part of 2011, no one cared about it, other than a very, very small group of technologists that were experimenting with this technology. If you fast forward to 2011, there was some publicity around a website called Silk Road, which was a website where you could go buy drugs and do other bad things. And that was really the first time that Bitcoin itself was attributed a value. You started seeing people kind of exchanging goods and services for Bitcoin. And that was, I think, the beginning of what I call the early adopter phase. And that was when you started seeing angel investors like myself, you saw entrepreneurs getting involved and starting to build the businesses that were taking advantage of the opportunities that this technology presented. Fast forward to 2013 is when the next phase started, which was the venture capital phase. So starting in 2013, you saw some of the most well-known investors, such as Andreessen Horowitz and Unisquare Ventures, Benchmark, Excel, investing in this industry, backing some fantastic entrepreneurs with great big ideas. And to date, about $1 billion has been invested into this industry by those venture capitalists. 2015 was the start of what I call the Wall Street phase. If you've been following the headlines, there's a lot of interest in especially the blockchain technology, which we'll talk more about. And in my opinion, in 2016, we're going to start the narrative turning back to the benefits of Bitcoin as a currency and as a store of value, which will lead up to what I think will ultimately be mass global consumer adoption once all this happens.
Thank you. I know that my colleague is setting up some chairs back there, but there are a few seats in the front here. If you want to move forward, anybody, there's 3 in the front row. I promise not to call on you. And there's a few over here on the aisle, so please feel free to come forward if you like. I should say that Barry believes that Bitcoin as a currency, as a store of value, is integral to this and essential and will grow in importance. That is not universally held. There's a really interesting discussion in the industry about that, and I'm going to ask Brad to talk about that in a minute. But before we do, Michael, can you help us understand what are the policy issues that this raises? What are the upsides and downsides of this?
Sure. Thanks, David. Let me just say at the outside, David mentioned briefly, I'm an advisor to Ripple Labs, but anything I'm saying now is only my own views and shouldn't be attributed to them or to David or to Brookings or the Hutchins Center or anybody else. David asked me to talk a little bit about the public policy implications. I want to talk first about some potential upsides, and then I'm going to talk about some potential downsides. And let me emphasize as I'm talking about them the fundamental fact that nobody really knows. This technology is still very much in its infancy, and the directions that it might take, I think, are still very much up for grabs. David mentioned and Barry mentioned these 3 kinds of functions for the underlying technology. The role as a currency, the role as rails or transmission mechanism for transferring value, transferring money over time and space. And a third basic function of having a ledger, having a way of knowing what the accounts are in the system. I'm myself quite a skeptic about the first of these uses. That is, I'm quite skeptical about the use of Bitcoin and the underlying technology as being important for currency purposes. But I think I'm quite encouraged about the potential for the underlying blockchain technology and distributed ledgers, so the system for transferring the money and the way of accounting for it, as being quite possibly extremely significant for the way that we send money and account for things in lots of parts of our economy. And I think it could really be quite transformative. So let me talk a little bit about some of the potential upsides. One upside is simply reducing the costs and increasing the efficiency and speed of our system for sending money. We have a very outdated system in the United States and to some extent globally for sending money. And we spend lots of money sending money that we could spend doing other productive things in our economy. So one, I think, really quite, in a sense, low-hanging fruit for the changes that are in this technology is to wring some of the inefficiency out of the system and to be able to send money more cheaply and more quickly. That can also have implications for social policy. So if we can, for example, send money more quickly and more cheaply, we can reduce the costs of sending remittances overseas. So if you're a worker in the United States and you want to send money home to your family, it's still extremely expensive to do that in the payment system we have in this world. And the technology that's available with distributed ledgers and blockchains can dramatically reduce the costs of doing that and the security of doing that. A second potential implication is reducing for consumers the incidence of overdraft. Consumers spend $32 billion a year in overdraft fees. If you have instantaneous trusted transactions, you can eliminate that kind of risk and cost. Another potential implication is around the way we use our mobile devices, our phones, or the internet. We all basically give away our privacy to very large companies in exchange for being able to use the internet. If we can reduce the costs of transactions sufficiently, we might be able to give consumers the choice of keeping their own privacy, having ownership of their own information, and paying very small fractions of a penny for transactions. It's not really possible in the current payment system, but if we squeeze down that cost sufficiently, we might gain more ownership of our own financial lives and of our own privacy, which I think would be all for the good. We might be able to improve security. We might be able, there are downside risks I'll talk about for terrorist financing and money laundering, but there are also upside potentials of using this technology to do a much better job catching the bad guys at a much lower regulatory burden on the financial system. And I think this should be certainly deployed. We have the ability to use this kind of technology to improve financial stability. So one problem in the financial crisis was that it was very hard for both regulators and market participants to understand who owed what to whom when, what collateral was where, what transactions had been engaged in that exposed one part of the system to risk. And with this kind of technology and distributed ledger, it could be deployed to make it easier for the whole market to see exactly what is going on in the financial system. And that could be significantly enhancing to the networks of trust that undergird our financial system, a way of building that trust because the information is all fully exposed and open. Another potential upside implication is for corporate governance. So if we have used this technology of trusted architecture and open ledgers, we could significantly improve the ability of investors to see what is actually going on in the balance sheet of firms and to have more trust in the accounting of firms and a reduction in fraud and restatements at firms if we have that ledger that describes exactly the sequence of events that leads to a balance sheet. We could even, in my view, this may be counterintuitive, I think we could improve corporate governance and have a longer-term view if we use this kind of system to have firms reveal their balance sheet every single day to the public instead of managing for quarterly earnings. And that could significantly improve long-term corporate governance with daily kinds of disclosure. So all of these things are examples of potential upside. They're all just ideas. What are some of the potential downsides? One of the potential downsides is not fully understanding the implications of a combination of factors in technology. So many of you have heard of high-frequency trading or artificial intelligence in finance. There are aspects of this underlying blockchain technology that share three features with that: scalability, automaticity, meaning a machine does the work, and immediacy, the transaction is instantaneous. That has lots of benefits in terms of the speed and efficiency I described, but it may also introduce new risks into the system that we don't really understand. That we don't really understand what the machine is doing and how it will react in particular moments. If you have a self-executing contract that changes, for example, from debt to equity in certain circumstances, you might be able to use that to improve the strength of the financial system, but what if it triggers in ways that you don't expect in unanticipated circumstances? So there may be new risks. There are certainly money laundering and terrorist financing risks with this technology in the same ways or in different ways, but in similar sorts of ways to the ways there are with other forms of payment systems. And we need to be cognizant as this system is developing that there are important regulatory oversights in place so it's not used for wrongful or harmful or scary purposes. There are risks that the system itself could be vulnerable because of cybersecurity attacks, operational risk, weak governance, so-called mining pools that try and take over the Bitcoin system, or other attacks, hacking attacks on the integrity of this distributed payment system. There are potentially consumer and investor protection problems with consumers being able to understand, investors being able to understand exactly what's going on in transactions and to have those transactions protected in a sufficient way. And lastly, there's a public policy risk that all of this concern about these various, legitimate concern about these various issues I've just raised leads policymakers to take steps that lock in the dinosaurs, that lock in old ways of doing things, that lock in dominance of banks, that lock in outmoded ways of sending funds. And if we kind of create a regulatory system that advantages the dinosaurs, we're going to lose out on that potential innovation. So that kind of balance between openness to change and the risk of the innovations that I've described is one I think that is going to be an ongoing challenge.